Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. I am also here with our foreign correspondent for celebrities and politics, Alex, intern Alex. Glad to have you guys both with us. How are you?
What's up, Gary? Doing well. How are you?
Good, good. We've got the Trump Bitcoin issue, but another couple of days in the markets like this, it's going to be the all carnage issue.
Yes, it's a definitely tumultuous time. I know over the past 24, 48 hours, things have been very interesting. Lots of text messages, X group chats going crazy. Um, Dusting off my McDonald's uniform to go back to my day-to-day job. So, Gary, before we do jump into the five things, just
Wait,
want to get
hold
your
on.
initial reaction.
Wait, just a question for you, Rob. Is it true that the McDonald's jobs in California now pay $75 an hour?
They actually make more per hour than I make at this point in time. So yes, I'm actually considering it a slight upgrade and improvement for my overall mental health. So
Outs
it'll be a nice
Outstanding.
step in the right direction.
Very good. All right. So sorry, I interrupted you? What was your
Yeah, no
question?
worries. But Gary, I think just with obviously what's transpired over the past 24, 48 hours, before we even jump into the five things, kind of just wanted to get your overall thoughts, sentiments just on what we're seeing. I know there's probably a few uh, not surprising moments, right? In terms of information that's coming out, but just kind of your 2 cents on the last 24, 48 hours.
Yeah. That's a great question, Rob. So let's distill it down to three things. Let's just keep it simple, right? The first thing that's going on is, we've been team higher for longer for the past 2+ years. We've been right on it for the past 2+ years. That is no longer the case. Chairman Powell, and we'll talk about this during the episode, came on at his press conference last week and he was openly talking about September rate cuts. So we have moved our position from higher for longer to sooner rather than later, meaning rate cuts are coming. So, for the people who say we're being inconsistent, absolutely not. We change our point of view depending on the data, depending on what we're seeing. But the point of all this, some people are saying, wait a minute, the market has been waiting for rate cuts for 2+ years. Why would that make the market go down? And the reason for it is because the reason the Fed is about to cut is because they're starting to see the same weakness in the private market economy that we are. So, and this is stuff we've been talking about. We've been talking about a bifurcated economy. When you look at the aggregated data, it looks pretty good, but a lot of people are suffering, and that's why the Fed is going to cut. And so, what everybody's realizing is, oh no, the Fed is cutting for a reason. And if you take a look through history, it's very, very common for the market to decline when the Fed starts to cut. It's because it's an indication that the economy is turning. The second thing that's happening, and we will also talk about this in this week's episode, is what's happening in Japan. So, Deep Knowledge Investing started talking about the issues with Japan's debt, their interest expense, and what's called the carry trade. We'll get into that more later. But we started talking about that in October of 22, almost 2 years ago. And so what's happening now is the US Federal Reserve is about to reduce interest rates. The Bank of Japan has just raised rates, and that is causing the yen to strengthen against the dollar. And so people who are long the carry trade are short the yen. As the yen gets stronger, they're getting margin calls. And so they have to cover that position. That in turn strengthens the yen, which causes more margin calls, which causes other people to have to buy the yen. And so what we're looking at is an unwind of what's called the carry trade. And again, this is something we've been talking about here at Deep Knowledge Investing for 2 years. So those are the things making the market go down. The best thing that I would tell any of you is, Deep Knowledge Investing subscribers have known about my concerns for a couple of years now, and they should be heavily hedged. And so, while certainly it's been a rough couple of weeks for a lot of people, because we've been heavily hedged. I think we've had a lot of days when we've outperformed by hundreds of basis points. And that's a key thing in terms of portfolio risk. We've been really careful on that, and that's been paying off the last couple of weeks.
Gary, talking in particulars before we do get into the five things. Yeah, that's what I was going to kind of ask. As a DKI subscriber, if you're closely aligning, right, your current portfolio to yours, how are you feeling today just in terms of where your portfolio is positioned?
So not so different. And the reason for that is because I own some, and Deep Knowledge Investing owns some economically insensitive high growth stocks. We own things related to cybersecurity, biometric security. This is not like Meta saying we're going to cut tens of billions of dollars of spending on Nvidia chips. People aren't going to cut spending on that. We've been buying stock and drug companies where their primary payer is Medicare and Medicaid. So these aren't such economically sensitive sectors. I think long term, owning energy and uranium, which we've talked about ad nauseum, those are really good places to be parked long term. We've done really well in gold. You guys all know I'm a huge Bitcoin fan. Obviously, that's been going down with risk off. But I don't own Bitcoin because I have a view on it for this month, this quarter, this year. I own it because I have a view on fiat currency for the next 10 to 20 years. And so, that part of the play doesn't bother me that much. And then, obviously we started to make a lot of money in our hedges. We've been long volatility, we've been short market indexes, and those have created just massive outperformance. We've had a bunch of days where, at least in my portfolio, there's been outperformance in a single day of 200 to 300 basis points. So, this kind of volatility, while it's not fun, at Deep Knowledge Investing, we're very well equipped to handle moments like this. And, our portfolio is well equipped to handle moments like this. I've lightened up on some of my exposure, but for the large part, I'm sticking with the bets that I have because I like them, because I think they'll perform well. And, a lot of these are stocks that will do well, whether we have what anybody would consider to be a good economy or a bad one.
Moving into this week's five things, Gary, this is the hashtag Trump, hashtag Bitcoin issue. We're going over new economic data. Obviously, as the title ensues, President Trump and a Bitcoin strategic reserve. We're talking Bank of England, Bank of Japan, and again, revisiting the Magnificent Seven. Gary, starting with thing number one on this week's five things, new economic data is not positive.
All right, this has been the key thing. And again, at Deep Knowledge Investing, we've been talking about a bifurcated economy for about a year now. What we've seen is massive amounts of government stimulus spending, and that makes the unemployment numbers look good. That makes the employment numbers look good. The government has been the primary source of new jobs. That makes GDP look really good because they're spraying trillions of dollars of stimulus into the economy. But the other side of that is it's crowding out the private market economy. This is something, Rob, we've been talking about pretty much on a weekly basis. Um, and so we have a lot of people who aren't doing well and who are struggling to pay the grocery bill or pay their rent. We've seen all kinds of increases in delinquencies for things like rent, credit card bills, a lot of delinquencies in automotive payments. And so, what we got in the last week was a lot of data showing that the economy really isn't in such good shape. This is consistent with what we've been saying. We've been saying you have to tease these things apart and separate government spending from the private market economy. So, looking at the data, because I know everybody tunes in here to hear me read numbers, that's got to be the only reason, right? Everyone
Pretty
loves
much.
hearing, right? Who wouldn't want to hear economic statistics? So, let's go.
I mean, outside of that, I'm not sure what we're bringing to the table, right?
Exactly. Thank you. Thank you very much. So on the employment front, and again, you guys know my view of our employment statistics slash lies. Our employment numbers are not accurate, but we've got what we've got. The July non-farm payrolls were up by only 114,000. Is that a bad number? It's not a horrible number, but the market was expecting 175,000. That's a huge miss. It's an even bigger drop from the revised June number of 179,000. And the only thing that I can tell you is with a high degree of certainty that 114,000 number will also be revised down because it always happens. The unemployment rate rose to right around 4.3%. That was higher than the anticipated 4.1%. There's been a lot of talk about illegal immigration, or what people are calling migration or colonization, whatever you want to call it. But there's been a lot of talk that that's going to help our labor markets. And, I do get messages from people saying, hey, I run a business in this part of the country, or, I'm in that part of the country. We cannot find people to work. We need these people. Okay. Fair enough. But part of what's happening is you have millions and millions of people crossing the border, and they get added into the denominator. And so you end up with a higher unemployment rate. This is one of these things where labor mobility is important, and we want to get people into places where it's hard to hire people. You want to also avoid having a constantly rising unemployment rate. So it's a little bit of a tricky thing. New unemployment claims rose to a staggering 249,000, 250,000 new unemployment claims. That's a big number. The wage data was not great. Average hourly earnings grew by about 0.2% month over month, and 3.6% year over year. That's not awful, but the issue is that the recent numbers are falling short of where inflation has been. So people are falling further behind. And then the final statistic we have for you is the manufacturing PMI had been at 48.5. That fell to 46.8. Is that a big deal? Yes. And the reason is anything under 50 indicates contraction, or rather less manufacturing. And so, when those numbers are below 50 and falling, that's the kind of thing that the Federal Reserve is going to look at.
Gary, when we got these unemployment numbers, I know on X they're circulating. I tagged you in one post that said, unexpectedly, this happened. Was this news kind of the catalyst that led into the rest of the events over the weekend? Was it the combination of even the certainty of the Fed rate cuts? What do you make of that?
Rob, I think a lot of it was the yen carry trade starting to unwind. I think that's what people were starting to look at over the weekend. That said, I do think you can draw a straight line between this data being negative, the Federal Reserve speaking openly about saying, yeah, we're looking at cutting in September. And then the market realizing, oh no, the Fed's going to cut because the economic data is bad.
Mm-hmm.
Therefore, we're going to start taking down stock prices. I don't know that it was such a huge surprise. I think anybody who's been paying attention, or at least paying attention to this show, would have a pretty good idea that there were concerns about the real market economy, the private market economy. I think that's, that shouldn't be a surprise to people. Regarding the employment numbers, technically they might have been a surprise, but the unemployment numbers and the employment numbers have been just subject to so much revision. It's hard to get a sense that any of that's real. And by real, I'm talking about the data. I'm not talking about people who have lost their jobs. That the 250,000 people who have lost those jobs, that's horrible. And that's, I don't want to use the word tragedy, but those people are, many of them are going to face economic hardship. And I don't want to be insensitive on that. That's not my intention. What I'm pointing to is the fact that our employment data is just regularly inaccurate and then revised later in ways that indicate no one had any idea what was going on.
Gary, moving to thing number 2, and again, the topic of this week's issue, the Trump Bitcoin issue. We're talking thing number 2, President Trump and a Bitcoin strategic reserve. This might be why we have Alex back on the show, and I think he still has access to the Bitcoin conference.
Yes. Yeah, we've been teasing Alex for still wearing the bracelets for his. Yeah, there we go. He's gonna have those on for the next month. So Alex, tell us about your experience and how was it sharing a room with President Trump?
It was pretty incredible. That was my first time in the US, and no better way to do it than go straight and see Donald Trump himself speak. The day before Trump,
be careful what you say.
I'm going to be as calculated as possible. No, the day before was RFK, which is incredible to think that how far the kind of the Bitcoin industry has grown,
Mhm.
such that 2 out of the 3 main political candidates were at the Bitcoin conference. It was something. And RFK kind of set the bar pretty high. His knowledge on Bitcoin was nothing short of amazing. And he pledged, if he became president, to buy, I believe it was 4 million Bitcoin in a strategic reserve, and even came out and said himself that he owns, I believe it was 75% of his net worth in Bitcoin. So he set the bar pretty high. But the atmosphere with Trump was, I mean, it was nothing. It was nothing. It was compared to RFK. I mean, RFK was here and Trump was here. Most people stood for the entirety of the Trump speech, and it was delayed shortly. I believe, I think it was for about 30 minutes, but he crossed over some pretty cool points. He was really going in. He was talking about firing Gary Gensler, at which point the crowd erupted. He promised, as he has done previously, not to allow the issuance of a CBDC. And he kind of throttled back the idea of ending the war on crypto, as it were. He didn't, unlike Kennedy, specifically say that there would be a strategic Bitcoin reserve. But what he did say was that the seized Bitcoin that the US government does hold, that would be moved to the Treasury in a strategic holding. So he didn't promise to buy more. He was just saying, we're going to hold it in a strategic way rather than in a kind of seized way, as it were. And the last thing I'll say is his knowledge at the time did not seem kind of as strong as Kennedy's, and it seemed like he was there just for kind of the votes, and he didn't really understand Bitcoin and the crypto industry as much as RFK. But in 2 interviews I've seen him do afterwards, the one that was blowing up on Twitter, he was asked about the 35 trillion in debt that the US has, and he said to the interviewer that he would, well, why don't we just hand them a little Bitcoin check or something and wipe out the 35 trillion. So he does grasp the underlying Bitcoin thesis, which is something.
I actually like the idea. As somebody who thinks it was a mistake for the US to overspend and thus forcing ourselves off the gold standard, I like the idea of us having a hard currency, whether it's gold, Bitcoin, silver, a strategic oil reserve. I like the idea of having things like that backing the country, backing the dollar. I agree with you. I think RFK does understand the issues better, but the truth is, I don't really care. Like, it doesn't matter to me that much whether, President Trump could write Lynn Alden's next book, right? It really just is a matter of if he's in a position to enact pro Bitcoin legislation, and, treat it more like a currency rather than, a security, have Bitcoin friendly regulation. Like, I don't actually care whether he could write a book on it, whether, he could join in the FinX discussions on it. I care that he's pointed in the right direction on the policy for that. Alex, what do you think? Like, how much does somebody need to know to get policy pointed in the right direction, or at least appoint somebody who would write maybe regulation that would be more friendly to the industry?
Yeah, no, I completely agree with what you were saying. I look, he is a political candidate, and he's very busy. So learning about all these different industries, especially the new ones, whether it's AI, whether it's Bitcoin, it's unrealistic for him to really kind of dive into it. But he did say, I think you brushed over that he mentioned he would appoint I can't remember the exact title, but it was a head or a regulatory body for Bitcoin. And I think the phrase he used was, you will have people working for you who love your industry rather than hate your industry. So yeah, even he I think is surrounded by people who understand the kind of the power of this technology. And I think although he's not getting directly involved, he's putting it into good hands and putting it in the right direction, as you said.
All right. Other than that, how was your trip to the US?
Yeah, it was quite something. Yeah, it was pretty amazing. Besides the layover at JFK where there was a fire, but I did get to catch up with an old friend, so it was all in all, it was pretty great.
Yeah, and I had the pleasure of, when there was the fire, I had the pleasure of hosting Alex that night instead of sleeping on the floor at JFK. He came by my place. So I just want to announce to everyone here, Alex was a fantastic guest and he even made his bed in the morning.
And I
Oh,
think we have a new title for him, right, Gary?
Yeah, he's our foreign correspondent for celebrities in politics.
There we go.
Right. So first Taylor Swift, now President Trump and RFK. He's traveling the world, meeting with everybody everywhere.
Excellent. Excellent. Moving forward on to thing number 3, pivoting a little bit, we're going to the FOMC meeting. Gary, break it down for us. What's the FOMC?
That stands for the Federal Reserve Open Market Committee. They met on July 31st, their July meeting. Chairman Powell, he softened the language, or the committee rather softened the language in the press release. Previously they've talked a lot about we will not lower rates until we get inflation down to 2%. That's been softened now to where they're saying until inflation is heading toward 2%. They did that a couple of months ago. And the whole point of that one is they're signaling that they would be willing to lower rates before inflation hits 2%. The other key aspect of the press release, the big change, was there was a reference to the Fed's dual mandate. Now, for people who aren't, constant Fed watchers, we're going to explain that. First of all, the real mandate of the Fed is stable prices. That's 0% inflation. But no government agency or quasi-government agency ever sticks with just their mandate. And so that's been reinterpreted. One is to, instead of stable prices, to have price increases or inflation of around 2%, which is 2% too high, but that's where we're heading. The other aspect of the dual mandate is full employment. And so, what Powell and the Fed are realizing with unemployment starting to go up is there is an issue where, our current interest rates, which I don't think the current Fed funds rate is high, but it's higher than where it had been. There's a sense that if they lower it, we'll get more people back to work. And so, the question is, do we want full employment and high inflation? Or do we want to have, some additional people unemployed, but have lower inflation? And these are the trade-offs that the Fed has to weigh. But for the first time in years, the Fed started to talk about the dual mandate in the press release. And then, Powell got up in front of the audience. And again, to go back to what we were talking about before, flat out said, we are looking at possible rate cuts starting in September. And so, we've changed our view. We've spent 2+ years, almost 3 years now, saying higher for longer. We've been right on that. I remember people started calling for rate cuts in like May or June of 22. So they've been wrong for 2 years, and we've said higher for longer for 2 years. That is no longer the line around here. We are, for now, retiring higher for longer, and it's going to be rate cuts are coming sooner rather than later. So sooner rather than later is the new tagline on this, until we get a resurgence of inflation, at which point we'll be back on team higher for longer. Again, for the people who don't like that, our job is to make money. We will absolutely switch our opinion every time changing our opinion allows us to make money.
It does not ring a bell the way higher for longer does, but maybe it'll grow on me.
We have
We'll
to
see.
workshop it.
Yeah, we'll see in the coming days. But Gary, probably looking at 25 basis point cut in September. You're marking it as probable. What exactly does that do? What does that change?
So big picture, it changes absolutely nothing. Whether the Fed funds rate is, 5.25 to 5.5, depending on, which aspect of it you're looking at. If they change it to, 5 by 5.25, I don't think that's going to materially affect the economy. The issue is it's signaling, right? The probability that the Fed cuts once and says, okay, great, we cut, we gave you lower rates, we're done, let's go home. I think that's very, very unlikely. Typically, when they start to hike, there's a hiking cycle. When they start to cut, there's a cutting cycle. So I think, it's not that the 25 basis points is a lot. It's that it signals we're so concerned about the economy that despite the fact that the CPI is around 3%, we're going to cut now-ish. So I think that's the thing, that people are focused on and should be focused on for that.
Thing number 4, Gary, we're moving to the Bank of England. Thing number 4 on this week's version of the Trump Bitcoin issue, Bank of England rate cut.
Alex, you are our resident British subject.
Add that to the title.
Yes.
Yeah. Quite the mouthful.
Wait, hold on. Here's what I want to know. So they cut their rates, their version of the Fed funds rate by 25 basis points, right?
That's correct.
So
Yeah.
And they did that what, a week ago?
Yeah, I believe it was on Thursday.
All right, so resolve this for us. Is the economy roaring now? Is everything better? Is everyone back to work?
Well, actually, in the last few days, it's been a little more challenging. There's been a little bit of social unrest around the UK, and quite a few riots, actually. So I think this kind of the narrative of inflation has been pushed back, and I think other priorities are being taken. But I think it will be interesting to see how the Bank of England try and kickstart the economy again, to kind of help some of these kind of unemployment issues and social issues that seem to be taking over many cities around the UK.
So walk us through it. What are they thinking there? What data were they looking at? Was it a close vote? Here in the US, one of the things you notice is that almost all Federal Reserve actions are by unanimous decision. They might have 2 days of heated debate behind closed doors, but when they're issuing a press release, it always says this is unanimous. We all agree. There are very few outliers to that. What happens in the UK for this? What data are they looking at? How are the decisions made? Are they close? Are they unanimous? What should we know as Americans who want to understand the British economy and the Bank of England better?
So Andrew Bailey put out a statement on the Bank of England website. He put it on his LinkedIn as well, which is where I watched it. And his rationale for cutting rates was purely inflation based. And he was saying how inflation, I think at the peak was 11.2%, and just recently they've got it down to 2%. The way that it works is there are 9 members. They all vote, and this time it was pretty close. So it was 5-4, the deciding vote. Andrew Bailey, the governor of the Bank of England, in favour of cutting interest rates. And his going back to what he was saying, it was because inflation was back down to that 2% target. And he said a lot of the inflationary pressures that came from COVID and the war in Ukraine, those kind of shocks have faded. I believe that's the language he used.
Got it. So when you talk about inflation in the UK being down to 2%, that's the official number. Do you believe that? Because one of the things we talk about here is people use the CPI, the Consumer Price Index, as the marker for inflation. But we've spent the last 3 years telling people how and why the CPI is understated intentionally. How's it work over there? Like, is inflation really 2%? What are you seeing? What are people seeing?
So I'm kind of the CPI is a metric that is used. It gives you a figure in kind of a scalar, right? 2%, 3%, whatever. But inflation truly is more. It's more of a vector, and it affects different areas of the economy differently. After kind of COVID and Ukraine, I believe the UK out of Europe was most impacted by energy prices. Before coming to DKI, I worked at a bar just across the street, and our energy prices tripled just after COVID, which was obviously, I mean, it's crazy. Housing is still very, very expensive. I'm moving into a house next year at university, and that's that's a lot more than what my parents were paying when they were studying at university. But I think overall, I think inflation, the rate at which prices are going up definitely has gone down, but things are still very, very expensive, and it's very difficult, and everyone has to kind of in their way manage their money more so than they did 5, 10, 15 years ago.
So I think I want to highlight a key point that Alex is making here. And, economists and market observers, they all focus on disinflation, which is, a slowdown in the rate of change. It's a second derivative for those of you who remember your high school calculus. But basically, people who do what we do for a living often look at the rate of change. The issue is that we had so many years of high inflation, and those higher prices are now a permanent part of people's expense structure. And so if you have a situation where people's lives become unaffordable or close to unaffordable, and you get inflation down to, 1%, 2%, something that, we'd consider to be reasonable, that doesn't mean that they can afford it. It means inflation has come down, but their rent may be higher, or their food bill might be higher, or their fuel bill might be higher, and those prices are not coming down.
Alex, anything else to add to that final point?
No, I mean, I think what I would say is I'm lucky that I live in the UK, in the sense that there are many other people in many other countries around the world that deal with much worse inflation. So I am still very fortunate in that regard, but I do know a lot of people are struggling with it, but it's good that it's come down from its peak. We'll see if it can stay there.
Great. Moving to thing number 5. Now we're moving to Japan. Gary, thing number 5, Bank of Japan raises rates.
All right. So we're yeah, here it is. They're the only major central bank in the world that's raising rates. So
Yeah,
it's kind of
it's
funny,
like,
right?
wow.
They went from negative to a previous range of 0 to 0.1%. Now they raised to 0.25%. So,
Yeah.
people are up in arms here in the US. We've got a Fed funds rate that averages about 5.3%. Japan, their version of Fed funds rate is 0.25%. So, very, very low. But there are 2 points to make. First of all, let's talk about the carry trade, because it's confusing for a lot of people. But what's happening is pretty basic. For many, many years, Japan has had negative or zero interest rates, and so or if you look out further, their 5-year, their 10-year, they've traded at very, very low yields. So what people do is they short Japanese government bonds. And in doing so, they're effectively shorting the yen, and they take on a very small amount of interest expense. And then they take the proceeds from that and they buy dollars, and that strengthens the dollar against the yen. And then they take those dollars and they buy, say, US government securities, which are yielding much higher levels. And so they book that difference between the yields. And assuming that they don't get crushed on the exchange rate, they're basically booking risk-free profits. But that last part is the key thing, that assuming you don't get crushed on the exchange rate. So, we've talked about this. The yen slid from, a year and a half, 2 years ago, I think it was 102 to the dollar. Recently, just a couple of weeks ago, it was, I think, 161 to the dollar. That is a gigantic drop, about a 60% drop against the dollar in under 2 years. So, what happened now is Powell gets in front of the cameras and says, yeah, we're about to cut rates. And the Bank of Japan raises rates. And all of a sudden that carry trade starts to unwind. And people then start doing the opposite. So they're selling the US Treasury securities. They're then selling those dollars and buying yen, and then using those yen to cover their short position in the Japanese government bonds. And all of that buying has pushed the exchange rate on the dollar yen to below 150. Right? I think it was trading below 148 the last time I looked, and it may be even lower now. And what that does is that causes people to have margin calls, right? Their bank calls them and says, you're losing money. And if you want to keep this position on, you can either sell part of the position, or alternatively, you have to give us more money. Well, nobody wants to do that. So they unwind part of their position. And when they do that, you do another round of this. And that means more dollar selling and more yen buying. And so the yen strengthens. And so what we're witnessing right now is a huge unwind of this multi-trillion-dollar yen carry trade that's existed for years. And, if the Bank of Japan were to hike rates a couple more times, and the US Federal Reserve, instead of cutting 25 basis points, were to cut 50 basis points, expect there to be more of that. The other thing that I would add, and Alex is the one who did the analysis on it, and I thought it was fantastic. Alex, you were showing how, even though the Japanese government blew out their budget, their debt to GDP is about 260% right now, which is roughly double the insane debt that we have here in the US. But because they have a slower growth rate in their economy, they're not getting much GDP help. And so, I'm looking at this chart that Alex sent over. And if we go back to, Alex, where was this? I want to say 2007, 2008, the last time they had, positive rates. The GDP there was a little over 520. And so then they had a decade and a half of zero or negative rates. Now they're at 0.25%. And so after basically almost 2 decades of incredible stimulus, government policy, and massive government spending and running up huge debts, I'm looking on this chart right now, and their GDP is now in like the 545, 550 range. So basically, over almost 2 decades, they've gotten almost no growth, but run up huge debts. And this is, in my opinion, a great warning for us here in the United States, because one of the things we've talked about a lot is that our government spending is wasteful, that it destroys value. And so you can spend a lot and run up huge debts that you have to pay down the road and destroy your currency on the way to do it, and crushing the buying power of your citizens with inflation. But if the spending that you're doing is not producing value, if it's destroying value, then you're going to end up with the same problem Japan has, which is a lot of debt and a lot of inflation and a GDP that just isn't really going anywhere. And that's what's happened in Japan, and that's what we're risking here. Alex, does that make sense, or am I missing the point of your analysis here?
No, that makes perfect sense. And this chart is amazing, but I'd hate to take credit for it, as it was actually Andrew Brown who
Oh, it was Andrew
created.
who did this one.
Yeah, it was
All
Andrew,
right.
but it was a fantastic chart. I wish I could take the credit, but yeah.
Round of applause for Andrew. Andrew, this chart looks great. Great job, buddy.
We'll
have to have
follow
him
up with
on next
Andrew.
week. What's that?
Yeah. We'll follow up with Andrew
I
next
know.
week.
Sorry about that.
All right, all good. Moving to thing number 6. If Gary's not careful, we might have to change the name of this thing to the 6 things for next week. So,
Yeah.
but thing number 6, bonus, always giving you more value than ever. Another volatile week for the Magnificent 7, Gary.
Yeah, so the Magnificent 7, they have had 3 horrendous weeks in a row, and off to a horrible start this week as well. Basically, to cut through this really quickly, these stocks, these are, our mega cap tech stocks. Their stock performance has been incredible. And in fairness, it's been on great fundamental performance. But the issue is those stocks have done nothing but go straight up for about 2 years. And as a result of that, they're priced for perfection. And so any earnings that is not perfect, well, that causes a gigantic problem. And so, Meta, which we all know as Facebook, they started the week with strong earnings. They had a 22% year-over-year increase in quarterly revenue. So, good for them. But one of the things we saw is they've been spending tens of billions of dollars on AI, and people are starting to realize, hey, wait, we're not 100% certain we're going to get paid on this. After that, things got really, really bad. Apple reported a 5% increase in top line revenue, but again, the iPhone, which is 46% of their sales, you're not getting unit growth there. They're losing share in China, which is a big deal for them. To own Apple at this, multi-trillion dollar valuation when they're not selling more units, that's a risky thing. And that's something we've been talking about for weeks. The final Magnificent Seven earnings report for the week came from Amazon. They missed their revenue target. They experienced slowing growth in retail. Their Amazon Web Services, AWS, and advertising businesses did really well. But, after that disappointing earnings call, Amazon stock just got hammered. And the worst part of the week for everybody was Intel, which is not part of the Magnificent Seven, but, it's a big tech company.
Yep.
They had a horrible day. At one point, their stock was down 30% intraday. It closed, I want to say down 25, 26% the day they reported. Basically, they missed earnings. They announced a dividend cut. They announced layoffs. And, one of the things that I've been tracking just because I think Intel is interesting is their 13th and 14th generation i7 and i9 processors are having quality control issues. They're not properly controlling the power draw. And so some of these chips are burning out. And once that happens, there's no fix for it. Intel hasn't made it easy for people to find the fix, to figure out what to do, to figure out if they have a problem or not. As I understand it, and I'm going to admit I haven't done a ton of work on this, but as I understand this, if you have an NVIDIA GPU, there's a test that you can do to figure out if you have a problem. But I don't think Intel's making it easy for people to get any kind of like recall or warranty replacements. It's basically, they've been a phenomenal US tech company for decades, but boy, are they going through a tough time right now. And then, Andrew will throw up the chart here, but keeping track over the last 3 weeks, and this doesn't count today's carnage. Again, every stock in the Magnificent Seven is down over the last few weeks. The worst ones, Amazon is down more than 15%. NVIDIA is down about 20%. Tesla is down just a tiny bit more than NVIDIA. And then you've got Microsoft that's down somewhere between 10 and 15%. This has just been really bad performance all the way around. And again, we're filming this on Monday, August 5th. Those stocks all got hammered again today. I want to say, I'm doing this from memory, and actually let me check. I think NVIDIA was down 7%. Yeah. No, they came back. They had been down, I think 6 or 7% earlier in the day. They finished the day down 4.2%. But all these stocks were down 2, 3, 4%. And so, that's a lot of market cap. That's a huge part of the indexes. And that's why we're starting to see the S&P 500 and the NASDAQ dropping. Rob, I think the key part of all of this is people are realizing that these companies have spent tens of billions of dollars on GPUs for AI. And everybody's starting to realize, wait a minute, when are you going to start to get paid on this AI? Is there going to be a financial return on this? And so there's talk from some of these companies that they may cut some of their advanced spending. And that makes people think maybe future earnings won't be as good. That also would be the nightmare scenario for NVIDIA, which makes some huge percentage of its sales to a very limited number of customers.
I know that prompted a question for me, Gary, with DKI's position in uranium, pulling that all the way through, obviously a key component for the GPU manufacturing and creation. Your response to that?
I think that's a good question. And that's, a big reason why uranium has not done well over the last couple of weeks. Our position in it, which is still up 50, 60%, at some point was up considerably more. I do think there is something to that. The AI related GPUs have a gigantic power draw. And so we are going to need more infrastructure to power these data centers. In the end, would something like this slow adoption? Maybe. And the reason I hedge on that, there are really two reasons. One is I think you have to assume that humanity's desire for electricity, for power, for energy is only going to go up. The correlation between energy usage and a high material quality of living is about 100%. And, people want to live better lives. And you have, just 3 billion people in India and China alone who want more power and want to live a wealthier, more comfortable material life. So, I think that's part of it. The other thing is this infrastructure, Rob, takes years and years and years to build. It's not like anybody saw, oh, wow, Amazon had a bad quarter and Google might
For
cut
sure.
spending,
Mm-hmm.
right? So cancel the nuclear plant.
Yeah.
That doesn't happen. Just to make the decision and get permitting for a lot of these plants and to get them built could easily take 5-10 years. And the life of these plants tends to be 30, 40 plus years. So if somebody is in the process of going through permitting and planning on building a nuclear plant that would go into service, I'm going to say like 2030, and operate that nuclear plant until 2060 or 2070, I don't know that they're looking at these CapEx plans and saying, well, we're worried that energy demand in 2035 or 2052 will be slightly lower, so we're going to cancel the project. I just think these companies, by definition, have to be looking out somewhere in the neighborhood of half a century. So I understand why the stocks are down, but I don't think it's really going to affect infrastructure build yet.
That's why you get paid the big bucks, Gary, for that type of analysis here at Deep Knowledge Investing. That wraps up this week's show of the 5 things, the hashtag Trump, hashtag Bitcoin issue. Alex, thank you for joining us, our celebrity, what was that? PR International Bank of England expert
Celebrity and
correspondent.
politics correspondent, right, with additional responsibilities for the Bank of England.
That's exactly right. As always, please check us out at deepknowledgeinvesting.com. Subscribe to our YouTube channel. Follow us on LinkedIn, X, Instagram. We'd love for you to sign up for a free version of our newsletter. Paid premium version gives you access to premium content material, current recommendation, portfolio weightings, the whole 9 yards there in terms of how Gary and team is navigating the market. Gary, any closing statements from you?
Yeah, 2 of them. One, just to let people know, I know the markets have been really rough the last few weeks. That may be causing stress for you. One of the things we've done really well at Deep Knowledge Investing is set up hedges, put ourselves in a position where when the market's going down, we tend to outperform. That has been the case over the last few weeks. If you want some help with that, reach out. That's an area where we've been really good at helping people. We also added a new position to the portfolio. We have a small drug company with a phenomenal product. The key thing there is I think we're going to be expecting a huge amount of growth for them. It's a really important drug in a known large market. And it's not economically sensitive. This isn't the kind of thing. People don't get sick on schedule, based on the economy. So I think that's something that's really interesting, could be very helpful for people. Always, even in bad markets, we are always looking for and finding ways to make money. The other thing is, big round of applause to our interns, Alex and Andrew. Really glad to have Alex on camera with us today. He did phenomenal work this week, heading up the 5 things and working with Andrew, who this week will be heading up the 5 things. And sorry, Andrew, I got the attribution for that graph wrong, but both of these guys I think are doing just really high quality work. They've taken a ton of time off of my hands. They've made things easier for me. They've done great graphs, great writing, terrific job selecting. And so, if you're a young person, trying to figure out career options and you're looking at this, here are 2 of your peers who are succeeding and doing really well. And Alex and Andrew, I know you'll be hearing this in about 20 minutes or so. Just know, we're all really proud of you guys and think you're both doing a fantastic job.
It's very kind. Thank you, Gary.
All right, everyone. Thanks so much. We appreciate you watching, and we will see you next week.
Thanks, everyone.